Corporate Finance Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to the creation of a statement of cash flows. Get ready, because it's time to take a stance with corporate finance. Here we are in Excel. We have our information on the left-hand side, which is going to be including our financial statements of thus far, not including the statement of cash flows, because that's what we'll be working on. Then we're going to be putting together a worksheet that's going to help us to put together the statement of cash flows. And then finally, we'll have the statement of cash flows we'll put together from the worksheet that we put together in order to create it. So typically, the statement of cash flows is going to be the last thing that we will do in terms of the financial statements. In other words, we will typically put together the income statement and the balance sheet and then statement of retained earnings first, then the statement of cash flows. Why? Because you'd want to think about the balance sheet and the income statement as kind of like, I would think of them as the main statements because they include all the trial balance accounts, all the general ledger accounts that have activity in them will typically be reflected on the balance sheet and the income statement. The statement of cash flows is us reformatting, reshaping that information from an accrual basis to a cash basis, and that's what we will do here. So we want to get this information down first, construct the balance sheet, which is the statement as of a point in time, the income statement, which is showing the activity that happened over time, statement of cash flows, tying the two together by tying the retained earnings at the beginning of the period to the retained earnings at the end of the period, the major difference being net income, the activity that happened. And so that's going to be our project. Now, when you think about the statement of cash flows, you're thinking about a performance statement similar to the income statement because you're thinking about flowing of cash. That means it has a beginning and an end, as opposed to the balance sheet, which is a statement that's kind of unique, or the items related to the balance sheet will be different in that it's as of a point in time. So notice you're looking at a performance type statement. So therefore, you can kind of compare the statement of cash flows to be similar to the income statement. We're seeing something that's happening over time. There's three components to the statement of cash flows. However, the first component is similar to the income statement because it's going to be cash flows from operating activities, which is kind of like the cash flow basis of the net income that we would have on the income statement, the net income being on an accrual basis. But we also have cash flows for financing activities, cash flow that happened that would basically be related to balance sheet accounts, and cash flows from investing activities, cash flows that would be related to balance sheet accounts as well. So the major category of the cash flow statement is typically cash flows from operations. It's where the most things we have to do it will be involved in. And then we could have cash flows from investing and financing activities as well. So remember, there's two methods we could use, a direct method and an indirect method. We will typically be using the indirect method because that gives us a reconciliation between the net income on a cash basis and accrual basis, often something that's required. If anything is required by regulations, they like to see that. So even though the direct method is more intuitive, then the indirect method gives us that reconciliation. So oftentimes regulations require it, even if you do the direct method, and therefore people often just do the indirect method, or at least need to learn it in any case, because it could be in practice. Okay, so now we have this information. Now, to do the statement of cash flows, you're typically going to need a balance sheet for the current year. We're going to say is year 2. Then usually the balance sheet for the prior year, because that's going to help you to see the change that you will be dealing with. And then typically the income statement items as well. So that we need the financial statements for the current period as well as last year's balance sheet for the beginning balances. Now, although you're kind of thinking about this as a kind of like an income statement type of financial statement of cash flows activity, the funny thing is we'll be doing this by looking at the balance sheet more than the income statement, because we're going to look at the change in the balance sheet from last time period to this period. So although we're looking at the balance sheet, we're really using it kind of to back into the change, because we're taking a point in time as of last year and a point in time as of the end of this year, the difference between them giving us a summary of the activity that happened during the time period, similar to what the income statement would do. So that change that we're going to see on the balance sheet will represent then, oftentimes, part of what we have reported on the balance sheet. It's just useful for us to kind of back into this when we're using, especially when we're using this indirect method, by taking the change in the balance sheet accounts. Now, why would that be? Well, the balance sheet accounts are in balance. They allow us to use the double entry accounting system, assets equal liabilities plus equity, on the balance sheet accounts. So if we start with something in balance and we compare it to something else that's in balance, then the difference between the two have to be in balance. That gives us a check for us to work through this system and be able to put this together easily. Now, so this is what we have. We got our balance sheet. That's what we're going to start. We're going to focus in on the balance sheet right now. Now, the balance sheet has all these subcategories. We got assets, current assets, and then the actual accounts, and then liabilities and subtotals, total current liabilities and whatnot. It's usually easier. Some people will just use this balance sheet and take the difference between these columns, but it's kind of all those subtotals makes it a lot more busy of a thing to look at. So I would recommend breaking this down into another worksheet that basically removes all the subtotals so that we can work out with just what we need, and that'll typically be easier. In other words, I'm gonna just pull over the same information into our balance sheet for year 1 and year 2. I'm gonna remove the category headers, assets, current assets, and the totals, total current assets and whatnot, and just put together the meat of this thing, and it'll still trim it down a lot. So I'm going to say, okay, I'm going to pick up equals. I'm going to use some formatting to do this a little bit quicker. I'm going to pick up the cash, and then I'm going to use autofill to sum it down to 3 other accounts. I'm going to put my autofill and go down 3 more accounts, so it picked up all those numbers. I'm going to pick up the amounts then. This equals the 80,000. I'm going to do the same thing with autofill, put my cursor on autofill, scroll on down. I'll do the same for year 2. This equals the 100,000. Then I'm going to go to the autofill, and I'm going to take that all the way down. We'll do the difference later. We're going to do a difference calculation, and that'll be what we'll use, but I'll do that at a later point. So notice I'm not going to pick up the total current assets here, and then I'm just going to jump down to the inventory. So the investments, I should say. Investments. So I'll pick up the investments. This is going to be equal. I should say investments because inventory was wrong. So that's why. And then I'll pick up the 70,000 investments in year 2. And then we're going to be skipping on down. Once again, I'm not going to put the subtotal property, plant, and equipment. We're just going to go right down to the actual account with the actual number in it. And we'll pick up the property, the plant, and the equipment. So there we have that. And I'll pick it up for the other side as well. So there we have that. And then we have accumulated depreciation. Now, I'm gonna put it in there right as it says. The accumulated depreciation often confuses people because it's a contra asset account, meaning it's kind of connected to this account. Really, the main account is this one because it sums them together. But we got to break it out, so it's going to be subtracting or reducing the assets, which is confusing. So we'll pick that up. Beware, and then this is going to be for year 2. And then we're going to skip on down to we're going to be skipping down to accounts payable down here. So we'll stop the skipping down on accounts payable, and then we'll pick that up. And then I'm going to autofill down 2 more to pick up these other couple accounts. So we're going to autofill on down. And then we'll pick up the number being the 260. Let's pick up the number for year 2 and then use our autofill for 2 cells. I'm going to highlight these 2 or select them and then autofill them on down, and they should pick up the relative cells like that. That looks good. And then I'm going to skip on down. We'll start skipping again until we get to the bonds payable. We'll stop skipping and pick up the bonds payable. This will be equal to the 70,000, and the other side will be the 120,000. Then we're going to start skipping again until we get down to the preferred stock, because we don't want those category sections in there because they just are going to muddy up the whole thing. And then I'm going to autofill that down. Actually, let's autofill 3 cells this time. Let's add the amounts, the 90 here. Let's add the 90 here. And then we'll use the autofill for these 3. Autofill and add those up on down. Okay, so there we have it. Now I'd like to verify that I got this information in there correctly. So what I'm going to do is I'm going to say, okay, let's see if I can color code this a bit. I'm going to say these are all the assets down to here. This one's a contra asset, but these are all assets. I'm going to make them green, right-clicking on it. I'm going to make those green. And then these are going to be the liabilities down to here. I'm going to make those yellow to indicate liabilities, or orange. I'll make them orange. And then these are going to be the equity. I'll make them blue. just to indicate that they're the equity. And then I'm going to do our summing up down below, and I'll say, all right, now let's add these up. I'm going to say assets, liabilities, equity, and then I'll see if the liabilities, and equity should equal the assets. So we'll put our accounting equation down here, assets equal liabilities plus equity. So the assets are going to be the green ones. So then the liabilities are going to be the orange ones. And then the equity is going to be the blue ones. And there we have it. Now I'm gonna do the common problem, the common error that most people will do when they do this, and that is that they won't subtract the contra account, the depreciation, accumulated depreciation, and they'll add it, and then you won't be in balance. So let's do that, and I'll show you it won't be in balance, and we can use the accounting, double entry accounting system to fix it. So I'm going to say equals the sum of all the assets, which is going to be the 80,000 down to the 1,000,001. So there we have that, all the assets. And again, error here. We picked up the 1,000,001. We should be subtracting that, not adding it. But I'm going to keep it for now just so you can see we'll be out of balance, and then we can go back and fix it. Now I'm going to add up the liabilities equals the sum of the liabilities. And there's that. I'm going to say enter, and then we're going to add up the equity equals the sum of the equity. Sum of the equity. And then there's that. And then if I added up the liabilities and equity, the last two, assets should equal liabilities plus equity. Sum of the 800 and the 1,120,000. This number should equal the assets. So this does not equal the assets. And there's a substantial difference. And oftentimes if you have something going the wrong way and you have a difference, you could say, let me divide that by 2 and see if something is going the wrong way, right? And then I can say, that looks like this number. Oh yeah, that number should be subtracted because it's a contra asset account. So I'm going to say, all right, let's do this one again. I'm going to delete it. I'm going to go, okay, this is going to be the sum of these, close it up, and then minus the contra asset. And there we have it. So that puts us in balance. This number meets this number. And then I could do it. I'll just do it again, although I could copy these over using the autofill. But I'll do it again just so we can emphasize this again. We're going to say equals the sum of all the assets except the accumulated depreciation. Close up the brackets and then say minus the accumulated depreciation. Then I'll sum up equals the sum of all the liabilities. All the orange ones. So there we have that. And then I'll equals the sum of all the equity. Close that up. And there we have that. And then I'll say equals the sum of the liabilities and equity. So assets equal liabilities plus equity. These two accounts match. That looks good. We're going to take the difference. Now, if we have something that in year one, these group of numbers are equal, or the formula of assets equal liabilities plus equity here, these have the same relationship, assets equal liabilities plus equity. If I take the difference between each account, then the difference column will have the assets equal the liabilities plus equity, or we can use that same, double entry accounting system equation here. And that means that once I have the difference, I can then, as long as I find a home for all of those differences, my cash flow statement has guaranteed to work. And that's what we want to do. We want to feel like, that we know exactly how to put this thing together, and that if there's a problem, I know in my mind when I'm putting the puzzle together, just like if I look at the box, I know these pieces fit together in that picture, right? If I don't believe that, if I can't prove that to myself, then it's going to be hard to move forward and try to make the thing work. Okay, so we're going to say the difference is going to be, I'm going to say equals, I'm going to take the 100,000, the current period, minus the prior period. So make sure it's the current period minus the prior period, and that gives us the 20,000. That means that in year one, cash went from 80,000 up to 20,000. Therefore, there was an increase of the 20,000. So I'm going to autofill this all the way down. I'm going to put my cursor on the autofill handle and just copy that formula all the way down. Therefore, the same formula happens down here. You can see the same formula if you double click on them all the way down. If I was then to add up the difference column in the same format, will this relationship hold? It should. Sum of the assets, not including the accumulated depreciation, minus the accumulated depreciation difference, is the 315. Sum of the liabilities is going to be the 215 equals the sum of the equity is going to be the 100, and then the sum of the liabilities and equity is the 315. That equals the assets. So that means that this difference column is then what we're going to use. This difference column now represents something similar to what the income statement represents. It represents the change from where we stood as of the last year to this point as of the end of this year, where we stood as of 12/31 last year as compared to 12/31 this year. So that's what we're going to be representing on the statement of cash flows. We're going to represent that activity, and now we can do that in such a way that we see these differences. Now, what we're going to do is we're going to find a home for all differences except for cash. And by doing so, we'll be left with the difference in cash. So like if I add up all these differences, I get to, if I add up all, well, I have to subtract them out, right? If I had the assets minus the liabilities differences. So let's do that real quick. If I was to say equals the sum of all of the assets except cash, brackets, minus the liability, the contra assets equals the sum of all the liabilities, brackets, and then equals the sum of all the equity and brackets, then I'm going to say, assets are positive, liabilities, let's make them negative. Assets should equal liabilities plus equity. So then if I sum this up, it's going to subtract them, and that'll give me the difference in cash. So if I sum up all the assets, I got all the difference in assets except for cash. Liabilities, I'm going to represent as negative numbers because it's going to be assets minus liability. Assets equal liabilities plus equity. So then the equity I'm going to represent as negative. So if I take the assets minus the liabilities and equity, the difference is going to be the cash. So if I find a home, in other words, and if I make everything go the right way, the cells go the right way, increases and decreases go the right way, then the difference at the bottom will be that 20,000. It has to work, right? You got to convince yourself that that's going to work. Okay, so then we're going to find a home for these. So I'm going to say, we'll start off with the cash flows from operating activities. We'll start off with the net income. Net income. All right. Now I'm going to deviate a little bit from what you will typically see when you build this thing out, and that is when I put the net income in here, usually you should take it from the income statement, right? You take it here and you say, well, net income is going to be after taxes is the 160,000. So that's the number the ending number that will be there. But what I want to do is I want to find a home for all of the differences here. And if I put that 160,000, I don't see it as represented as one of these differences. I'd like to represent it as one of these differences. So what I'm going to do is I'm going to say, well, it should be the difference in retained earnings. It's not. Why? Because this difference in retained earnings also includes the dividends. So instead of me breaking this out, you can see where the dividends are. The 100,000 is there, and then we had the dividends that went out for the 10,000 for the preferred dividends, and then the 50,000 here for the 160,000. But I don't want to start breaking it out right now. I want to make it first as easy as possible and then go back in and fix it. So what I'm going to do is I'm going to say, I know this is not net income, but I'm going to represent the change in the balance sheet accounts that includes the net income in it, which is the 100,000. I'm going to make it yellow to represent that I need to fix it. And you might even put the actual net income, beside it. I might say, okay, here's what it needs to be at the end of the day, the 160. But I want to go back and change it after I find something that's in balance. And that way I can mark this number off and say I found that one. And once I find all of these, I should end up with a difference of 20,000. And if I have any problems with them, it should be easy for me to go back and figure those problems if I don't start breaking these numbers out into multiple components. Because when it gets complicated, then you want to simplify it, right? And then add complications in such a way that if there's a mistake, you can go back and fix it without starting the whole puzzle over. All right, so we're going to say now we have the adjustments to determine cash flows from the operating activities. We will typically see these as changes in the balance sheet accounts. So the first one's going to be depreciation. Now this is going to be another one. Depreciation expense I should get from the income statement, right? I should go, well, that's on the income statement. Depreciation expense, I know that's a non-cash thing. It's on the income statement. It needs to be added back to net income because we decrease net income by depreciation and there's no cash involved with it. But again, I want to see this in terms of a difference or a change in the balance sheet accounts. I'm going to move this down right here so it lines up. So I want to see this as a change in the balance sheet accounts. Now, what would that change be reflected on the balance sheet accounts? It would be the difference between the accumulated depreciation. So that income statement account is usually the change in the accumulated depreciation, but it's not necessarily always the change, as you can see here, because we have 50,000 here and it's 150. Why would that be? Because there could be some other thing happened other than just recording depreciation expense for the use of the equipment or allocating the costs, such as a disposal or a sale. But again, I don't want to break that out, and you'll see that over here. You'll see, okay, there was a disposal of equipment fully depreciated for 100,000 and a purchase of equipment. But it's going to get confusing if I start to pull those numbers in right now. So what I want to do is say, okay, I know that I'm going to have to change that, but I want to do that. I want to go back and do that one step at a time so that I can work with something that is in balance. What I'd like to do is use one of these numbers and then further break it out later. So I'm going to say, okay, I'm going to use then the 50,000. I'm going to add that back in, and then I'm going to go back and adjust it at a later point. So I'm going to make that yellow. At the end of the day, it needs to be 150,000. Now, also note that this accumulated depreciation is a contra asset account. So the general rule that relates to all other assets as to whether we increase or decrease the cash flow statement will be kind of different for the contra account because depreciation is a contra account. So just be aware, depreciation and accumulated depreciation often mess people up with these things. All right, then I'm gonna go down straight down the list now. I'm gonna say, all right, we have accounts receivable change. I'm not gonna do cash because that's gonna be the bottom line. The change in accounts receivable, it went from 301 to 355. It increased by 54,000. Now you can do the thought process in terms of what happens when the asset accounts increase or decrease. What are we going to do to the net income? And then you want to learn kind of the general rule. So the general rule is when assets go up, we're going to actually decrease them from the net income on the cash flow statement. They're going to be a decrease on the cash flow statement generally. So I need to make this a negative number. So I'm going to say negative of this 54,000. Now, if you want to mull over that, think about the two accounts that are affecting the accounts receivable and the two transactions. One would be accounts receivable goes up. When we make a sale on account, accounts receivable goes up. The other side goes to income. And then we pay it off on a cash basis with a receipt of cash. Cash goes up, and then the other side is going to be the accounts payable going down. So that means that if accounts receivable went up here, in essence, we recorded income for which we have not yet received cash, overstating income from a cash perspective on a cash basis. Therefore, we have to decrease it. Once you kind of understand that, then you just want to apply the general rule. If there's an increase to an asset, then on a cash flow basis, we'll typically be decreasing it. The reverse will be true for then liabilities. So we found a home for that one. I'm just going to say, all right, found a home there. And then I'm going to say increase in inventory. Now notice I'm going to say increase or decrease based on what happened. If you want a generic worksheet, you just say change in these accounts. Yeah, but then you want to go back and give further detail saying increase or decrease. So this one went from 409 to 430, so there's an increase. So again, we're going to use the same rule and decrease the cash flow, applying the same rule we just thought through with another asset type of account. I'm going to make that yellow. Then we've got the prepaid expenses, which there's a decrease now. Prepaid expenses are an asset. Actually, this is prepaid insurance. which is type of prepaid expense, but it's an asset account. It went down from 50 to 30. Now, if it decreases, we're going to increase it to the cash flow. This is a negative number in Excel, so I need to once again flip the sign. So instead of hitting equals, I'm going to say negative of that 20,000, which will pick it up and flip the sign of it to a positive 20,000. So I'm going to right click on that and say we found a home there. Now the investments and the property, plant, and equipment, those are things that are not going to go in the operating activities. Why? Because the investment, I mean, if you think about how it goes on the books, it's not typically affecting the income statement. You put it on the books, you debit investment, you increase investment and increase or decrease the cash when it goes on the books, and when you sell it, you might have the gain or loss at the sale, which we would deal with on the income statement, but the investment itself will be an investing activity. So we'll deal with that at a later point, not in the operating section. Then the property, plant, and equipment, these are long-lived assets. Once again, they don't affect the income statement except for when we depreciate them, as we've already seen with the accumulated depreciation, the difference in accumulated depreciation being depreciation expense, which we have recorded here already. So if there's a difference in equipment, then that's not going to hit, the other side doesn't hit the income statement generally, right, in an accrual basis system, because like if we bought equipment, we would debit or increase equipment and then decrease cash. And when we sold equipment, we would increase cash and decrease the equipment and may have a gain in that case, which would be something we would have to deal with. Okay, so we're gonna skip that one. We're gonna go to the accounts payable then, liability account. Other side of that is on the income statement because the other side could be thought of as expenses typically. So we're gonna say there's an increase in the payable. It went from 260 to 445. So we're going to apply the opposite rule. So there was an increase to an asset. So when there was an increase to an asset, we decreased it. Now we're talking about a payable, which is the opposite. So it goes like the same way as the change. So the accounts payable, the liabilities go the same way as the change. So there was an increase. So we're going to increase here. If you want to mull that over, think about the transactions for accounts payable and which way they go. And then you could do the same thing we did with accounts receivable and then apply that rule to the other liability accounts. Then we're going to go to the notes payable. Well, let's make this one green or yellow. There's no change in notes payable, so we don't have to do anything there. If there was a change, we'd probably be dealing with that in the financing activity, not in the operating. Then we have the accrued expenses. So we're going to pick up the accrued expenses, and there was a decrease now. So we're just going to do the same thing as the direction that it would decrease. So we're going to decrease it to cash. So equals, not a negative number. We're just going to pick up that decrease, getting our signs going the right way. And then we have bonds. Now the bonds payable are typically going to be financing type of activities rather than things that, because the other side of it you can think won't be on basically the income statement, therefore not in the operating activities. So that's going to give us our total adjustments here. I'll put the adjustments to the right-hand side. Summing up these adjustments equals the sum of adding these up. That gives us the 160. I'm going to then underline here, go into the Home tab font group, and we'll underline that item. And then we're going to finally have the cash flows from operating activities. So cash flows because these are... this is an increase in the cash flow. So we're going to include the net income in our cash flow. So this equals the sum of the 160 and the net income. So in other words, we had the net income on an accrual basis. We added in our adjustments to bring it to a cash basis. And now we got the 260. We're still going to have to make some changes to it, but that's what we have at this point in time. I'm going to go to the Home tab font group, put an underline here, and then we're going to move on to the cash flows from investing activities. So cash flows from investing activities. Now, most of the time when people think of cash flows from investing activities, they think about actual investments, just like an individual would, right? And that would include, then enter this. Formatting, I've been indenting them as I go here, but usually the investments here, we have investments like stocks and bonds, and the investment here went down. So we're going to assume then that we sold the investments, and that would then increase. So we're going to apply the same kind of rule. It's an asset, it went down, We're going to have an increase on the cash flow that we're going to apply here. It's just going to go into another category because this is an investment type of activity. And one way you could think about that is, again, is if the other side of the transaction is on the income statement, then that would be something that possibly most likely would go on the operating activity. If it's an investment, like when we put money into an investment, we increase the investment and decrease cash, and then when we take the money out, we decrease cash, and we increase cash, we decrease the investment. If there's a gain on the investment that we take out, then we'll have to put that on the income statement, and we'll have to deal with that on the income statement. So, but the investment portion here, we're going to be saying that's going to be the $10,000, and then we have the equipment. Now, this is the one that's often more confusing, increase in plant and equipment here, because many people, the term investment can be a little bit confusing. When you say investments, from a narrow perspective, you're often thinking about stocks and bonds, but from the perspective of a cash flow statement, the putting of money into property, plant, and equipment is an investment into the future. So, in other words, even if we paid cash for property, plants, and equipment, if we bought these large items that are going to be affecting future time periods, we're going to put that, we're going to label that an investment. And you can think about that by, again, thinking if the other side of this transaction would affect the income statement as to know whether it would be on the operating activity. So, in other words, if you buy equipment, you would increase the equipment. The other side would be cash if you paid cash for it. And if you sold equipment, you'd increase cash, and the other side would be the equipment going down. And if there was a gain, then we would have to deal with the gain on the income statement. So there's an increase in the plant and equipment. Now, we have the $300,000 change here. Now, we know something funny is going on with the equipment, because the depreciation didn't line up. So what I would do here, same kind of thing. I know there was a sale or something took place that's going to muddy this up, and I'm going to have to break that number out and do something funny with it. But before I do that, I want to pick up this change first, and then go back in later and make any adjustments we need to make. So this looks like, if I was just to take that one number as representing what happened in the whole year, it looked like the equipment looks like we purchased more equipment, right? Because the equipment was here and now it's up to there. And if we assume we purchased it with cash rather than financing it, which would muddy the transaction, then I would say this needs to be decreasing here. So it'd be the same rule. It's an asset. So it went up. So we're going to put it in a decrease here. Now, we often finance equipment, and we might have sold equipment. So we're going to have to make that yellow and then go into further detail. But again, I don't want to do that until I find out that I'm in balance first, and then I'll go back in and break that number out into the more detailed activity that is necessary at a later time. So then we're going to have the cash flows from the investing activities. I'm going to sum these up then, equals the sum of these two numbers, and that's going to be the 290. Let's put an underline here by going to the Home tab, Font Group, and Underline. Then we're going to have cash flows from financing activities. Cash flows from financing activities is the last category of the cash flow statement. And let's make this one yellow before I get too far into things. So we had an increase in the bonds payable. So financing is kind of what you would expect. We'd have the long-term kind of bonds payable and notes payable, as opposed to accounts payable, which would be purchasing, short-term activities. So we have the increase in the bonds payable. So it's a liability that has going up. And so that it went from 70 to 120. So we owe more bonds payable. So you would assume then that we basically got more cash. We issued bonds, got cash would be the assumption there. So I'm going to say, all right, cash should have gone up for the bonds payable. Same kind of rule. It's the opposite of what happens with cash. It's a liability account. So we're going to go the same way as the change happened here. And it's just in a different category. It's down here in financing as opposed to operating. So I'm going to say, okay, we found a home for that one. And then we know that there was dividends that went out. And notice they're not represented in the change here. The dividends are going to be in the calculation of the retained earnings. So I'm going to put those in place here. I know that there was dividends paid. I'm going to say dividends paid. And I know those have been there, but I'm not going to put the number in yet. I'm going to say, I know those are there, but that's going to be part of this 160 that we're going to have to basically break out. So I'm going to keep that there for now. And then because I want to get something in balance, and I found a home for everything thus far. So the difference I should have right now is the 20,000 if I have everything going the right way. And then I can go back into these yellow items, fix them one at a time in such a way that it's systematic. So we're going to say, all right, then this is going to be the cash flows from the financing activities. I'm going to sum up the whole thing, including the yellow, equals the sum of the 50 down to the yellow items. So that's going to be the 50,000. And then we're going to say, okay, now I can add up the cash flows. So there should be an increase in the cash flows. I expect this increase of these three numbers, as you could see, to be 20,000, which is our difference in cash. So if we got everything going the right way, it has to work, just like we proved down here. So we're going to say, all right, then it works here. We're going to say this equals the sum of these. And there's the 20,000. I'm going to put an underline here by going to the Home tab, font, underline. Okay, but I don't want to leave it at just the change because someone reading the financial statements cannot easily tie the change out. They could figure it out if they look at the balance sheet and figure out the difference between cash. But we'd like to tie it out to a number on the current balance sheet, which is ending cash. Therefore, all we're going to do is we're going to say, all right, now let's get to ending cash. I'm going to add back the beginning cash, which is we're going to get from the prior year's balance. Here's it is from our worksheet. And then if I sum up the change, the 20,000 difference plus the beginning cash, I'll get the ending cash, which will be on the current period's balance sheet, the 100,000. And that number then can easily be tied out to the current period financial statements. So I'm going to put an underline here. We're going to go Home tab, font, underline. And then we'll put an underline here, Home tab, font, double underline, bottom line. Okay, so that looks great. Now I have something in balance, but I know that this number's wrong, and I know that this number's wrong. So now I'm going to go back and fix them, but I'm going to fix them in such a way that it's kind of like a double entry accounting method, so that we can then always see that this number should remain the same. In other words, if I break out what needs to be done here into wherever that breakout needs to happen, I should be able to do that in such a way that I remain at the 100,000 bottom line number, which matches what that number needs to be. So this income statement, we know that this needs to go up by this 60,000. So what is that 60,000? That's the dividends. That's the preferred dividends and the common stock. So here's the other side of that transaction. So I'm going to go, okay, so the preferred dividends is going to be equal to this 10,000, and that decreased. It should be a negative. It decreased. And then I know that the dividends for the common stock is going to be a decrease in cash, and that was for the 50,000 on the statement of cash flows. So 50,000 went out there. So there's going to be that $60,000 difference. And then the other side, I can say, all right, the other side is going to be negative sum of these two items is going to be the other side. And that'll bring us back to 100,000. So now I've got the 160,000 here, which is right. So I'm going to say, okay, unyellow that. And then these two are right. So I'm going to unyellow that. Then I also know that depreciation needs to be 150,000. Now these can be a little bit confusing, when there's equipment being purchased and whatnot. But if I look at the detail, I'd have to go into the GL and say, okay, what equipment was purchased, what was sold? They told us there was a disposal of equipment that was fully depreciated of 100,000. If it's fully depreciated, that means to take it off the books, there would be no effect on the income statement. We would decrease the equipment account, which would be this account, and we would decrease the accumulated depreciation for equal and opposite amounts, the book value then remaining the same. It's already been fully depreciated. We already allocated the cost out. It's just now no longer in use, so we took it off the books entirely and removing it from both sides here. So that then is that's why we have a change in accumulated depreciation that's not reflected on the income statement in the depreciation expense. So what I'm going to do then is I'm going to say, all right, well, that makes sense. Then I guess we're going to say then that this depreciation expense is going to be increased by that 100,000, and so that brings it up to the 150. And then the other side is going to be going to the fact that we purchased equipment for cash of 400,000, and we've got a purchase of equipment. It looks like 300,000 cash. Why? Because that 300,000 represents the difference in the equipment account of 300,000, but that's not the full difference. The equipment account went up by 300,000, but it also went down by that disposal of the 100,000. So the other side of that 100,000 then needs to be here. So I'm going to say plus, or it should be minus the 100,000. So see how it's kind of like a double entry accounting system that we're using. And that brings us back to the 100,000 down below. So now I'm going to say, okay, that checks off. Good. This makes sense now to me. Okay, so that makes sense. So that looks good. And then our bottom line number here ties out to what would be on the balance sheet here on our worksheet, or of course on the balance sheet for year 2. And that's what needs to basically happen. So notice bottom line, we used the indirect method. We took the net income, which is really the change or part of the change in retained earnings. And we backed out all the accrual things by the accrual transactions related to the income statement by looking at the other side of it, the change on the balance sheet. And then we made that adjustment, and then that means that this number is going to be the net cash flow from operating activities, which is kind of like the net income on a cash basis system that we have in the operating activities. Then we took a look at the cash flows from the investing activities here, and this is cash flows that happen that wouldn't be part of like the normal operating activities, things in investments like capital, like investments in capital, like property, plants, and equipment we purchased, and investment stocks and bonds that we purchased in other stocks and bonds. And then we have the financing activities cash flows, which include things like paying the dividends for the financing and the debt, like bonds and any like payables that aren't short-term payables, that aren't current liabilities. They're typically more long-term or notes and bonds and things such as that for financing. And then again, that will get the change, the difference, and then we're going to add up the beginning balance to get to that ending balance that we can then tie out to the other financial statements. So we can tie all the financial statements together, tying them out to the balance sheet at the bottom there. Bottom line of the statement of cash flows tying out to the balance sheet.